Welcome to WuBlockchain podcast. Today, we're thrilled to have Ariah, the co-founder of Gyroscope. Welcome to the podcast, Ariah. How are you doing?
Yeah, thanks for having me. Doing great. How are you?
I'm doing great, thanks. So I guess before we dive into the world of stablecoin and how Gyroscope is doing, could you please introduce yourself and share a bit about your background?
I'm Ariah Klages-Mundt. I'm one of the co-founders of Gyroscope, which is a decentralized stablecoin that's designed to be the most liquid and resilient that we think you can design a stablecoin to be. And we also have a new class of more efficient automated market makers. And my background is coming from a mix of financial technology, as well as doing a PhD in complex systems, computer science, applied math. So I really did also a lot of the early work on the academic side of modeling stablecoin systems and thinking about kind of like failure modes. And so some of my earlier research, for instance, looked into some of the issues that actually later occurred in DeFi around like the Black Thursday.
Yeah, your academic background is fascinating. Could you tell us more about how your studies led to the world of stablecoins and ultimately to founding Gyroscope?
So I started my PhD looking at complex financial systems. So this is basically like where you have a network of economic agents, usually like different types of firms, and you want to understand what are the complexity of having this sort of like a complicated interaction network. And what you can have happen is basically you have something that happens in one part of the network can have kind of like an unexpected effect on other parts of the network. And you kind of need, it becomes almost as complicated enough that you need like a computer science model to actually work out how does the economics actually affect different parts of the network. And I was doing this sort of angle of work when Maker first came out. So this is back in late 2017, early 2018, and Maker was just a very good example, I guess, of like how you can have similar sort of complex systems built in the blockchain world, like built on top of Ethereum in this case. And you want to be able to do similar sort of analyses and kind of understand like what can happen in these sort of systems where you also have like similarly like a lot of different agents that are performing these different roles, and in this case like trying to make a stable currency. And there wasn't a lot of groundwork really about what can happen in these systems, how can they fail, how can we design them to be more resilient. And so that's what drew me into the world of DeFi, I guess, even before it was called DeFi, probably back then. And
when was
I did some. This was 2018 when I was like first starting to do these stablecoin models.
Yeah, it was definitely early.
And so one of my first papers there was looking at what I called at the time deleveraging spirals that can happen in the original Maker design, which is basically like a short squeeze effect if like lots of people have to deleverage their CDPs at the same time. And this actually happened then, like 2 years later in 2020. So yeah, it was kind of interesting from my perspective to like kind of be the first person kind of doing a lot of the groundwork here, and then like actually see it have like an impact, because like the stuff you were working on like actually happens. And I mean, that's the second thing that basically drew me into DeFi longer term, is basically it's easy to get started, do something that like makes a difference, like has some meaning, stuff that actually like is helpful to know about. And then get like your own kind of like thing off the ground from there. Like it's really easy to make financial products basically in DeFi, like experiment with new sorts of designs.
Yeah, because you kind of foresee everything since 2018, and then you kind of saw that happening. That's definitely an interesting journey. And I know you guys done extensive research on stablecoins, have written a few papers published in academia space. Could you please, besides foreseeing the DAI death spiral, share with us and the listeners some key insights from your work that we might find particularly interesting or surprising?
Another big one was what happened with Terra, basically. I was one of the early critics of Terra, I suppose you would say, basically seeing through what they said their design was into like how it actually like works or really didn't work, like on the actual economic side. Like if you actually distill what's happening in the Terra design, it amounts to, I mean, basically something like a Ponzi scheme where you have new funds coming in and it's being paid out to what essentially amounts to is like past investors, which means you have like nothing left in the system if you need it to maintain stability or kind of like allow people to redeem, etc. And maybe one also interesting fact about that is that one of our papers that looked into this actually termed the name like endogenous collateral stablecoin, which is now kind of like a much more picked up term to kind of like describe these systems.
And what is it?
It basically means the term is endogenous collateral stablecoin, and this was actually picked up by like one of these draft like U.S. stablecoin regulation bills even. But it basically describes something like Terra. Like there's some parts of Terra that you can think of as like almost like collateral. In some cases, it's like very explicit. In some cases, it's not. But like all of these like algorithmic sort of or stablecoins that are so-called like algorithmic backed kind of have this like endogenous collateral idea. There's something that's kind of backing the system, but it's like an asset that's like directly tied to the system. Like it's only valuable because the system has value, and so it's just a completely circular thing. And you could say something similar about like other Ponzi schemes, sort of things that look like Ponzi schemes.
Yeah, there are some definitely compelling points there. I definitely want to dive into it a little bit later. But before, let's kind of like zoom out and talk about the stablecoin industry as a whole. It is definitely one of the first teams that been developing in the stablecoin industry. What do you see as the primary drivers of growth in this sector? Even though we kind of seeing like Bitcoin, Ethereum kind of like stuck within this range, but we keep seeing newer stablecoins and the total supply of stablecoin on the rise. It is please just dive into like an overview of the industry from a insider perspective.
Yeah, stablecoins are kind of like I mean, people say it's like one of the killer use cases is like actually gaining traction in crypto, and I find myself agreeing with that quite a lot. When you talk with the actual users of crypto and DeFi, but also maybe not like particularly users of DeFi, but just crypto in general, what they want is on one side, like what people want is like leverage, and like that's kind of its own beast. But if you look at the other side of like where people are actually like using these systems in like a kind of like a natural organic sort of demand way, it's because they want access to financial services that they might not otherwise have access to, or that they want to like take custody of the assets themselves. And that's where stablecoins really enter the race, because people of this category don't necessarily want to just like take on only exposure to like ETH or Bitcoin or whatever other volatile crypto assets you have. They want to take access to dollars, basically, and maybe that'll expand also to like other types of currencies as well. But right now it's predominantly dollars, and wanting to do financial things with dollars. And the only way to do that right now in crypto is with stablecoins.
Yeah, thanks for breaking that down. For our listeners who might be like newer in this space, could you explain like there are different types of stablecoin? So you mentioned there are types like non-custodial like DAI, and there are custodial ones like USDC, Tether. what are the differences between like this type of stablecoins, and I guess like what are the challenges that you see going forward? Do you think there is going to be one type of stablecoin, for example, custodial ones, centralized ones, being the winner at the end, or do you see algorithm stablecoins will still kind of have a lag in the industry going forward, which doesn't seem to at the moment?
I would say there's a whole spectrum of things to think about when thinking about stablecoins, and I guess I probably want to focus on like the risk angle of this. Like as a user, like you want to use a stablecoin, but kind of ideally you should also like understand the risks of using different stablecoins, and in particular like they're quite different between like different types. And so I think of it as like overall like a risk space for stablecoins. And there's some convenient ways to kind of like chop this risk space up to kind of like understand it better. But it's also like, it's also pretty complicated. It's like any other financial system. Like it's complicated enough that like there's not just one clean way to like to chop things up into little bite-sized pieces. So just be aware that of course like it's very complicated, and it should be complicated. If you think it's not complicated, or if you a lot of stablecoins, for instance, like try to make it seem like they're building something that's not complicated, but it's really just ignoring the complications, I would say. So I just want to make sure that like people understand it's supposed to be like complicated because that's what financial systems are. But let's try to understand it like as best as we can, so that real users can understand the actual risks of using these different types of things. So how I think about like breaking down this risk space of stablecoins is first thinking about kind of like decentralized risk factors and centralized risk factors. And in some ways you can divvy up stablecoins based on this, although it's becoming less clean for reasons that I'll share in a second, I suppose. But like on one side, on centralized stablecoins, you have like the biggest players right now, like USDC, USDT, and some new entrants there as well as like the new real world asset RWA backed stablecoins. And on the decentralized side, the primary player in the back has been DAI, now USDS with their rebrand, of course. And a few other players kind of like basically just getting started on the decentralized side. And at a first glance, the risks that you can think of on the centralized side are basically that you have a centralized asset issuer. It's almost like interacting with a bank in some ways, although that's not like necessarily the best comparison. But you have a centralized issuer that if you actually want to like mint or redeem your stablecoins, you do have to go through them. They have quite a lot of discretion about like whether they service you or not. And in particular, if you are maybe not from the right jurisdiction, or you don't have the right documents, or for whatever reasons, like you're unbanked, you may have difficulty actually interacting with these issuers. And so you can only like in those cases use these products like by trading on like the secondary market. So using them on chain, of course, you can like swap through a decentralized exchange, but you might not get the kind of like guaranteed price, so to say, of like 1-to-1, depending like what happens in the market. And the risks also go further. There's like a bunch of regulatory risks because the regulatory landscape about centralized stablecoins is pretty unclear. It's unclear how it's going to evolve into the future, and what like new requirements might enter the space, or what sort of products might get shut down. And of course, if you're a user of these products, you need to be aware that like that those are possibilities that you may encounter. As well as like different geographic risks. The regulatory risks are potentially somewhat different depending on like the geographic user base and like basing of these different products. And on the decentralized side, you have basically a host of other risks. These systems are usually built based on like some sort of machinery on chain, and that machinery like always requires like an oracle, for instance. And these oracles are today another source of like centralization. Basically, most of these oracles are basically like a multi-sig model, and so you're relying on sort of like a multi-sig security model to import the price of assets in USD, so that you can actually tell the system like what its backing is worth and what should be allowed for like minting and redeeming these stable coins on chain that are these decentralized stable coins. They also commonly have a lot of smart contract risk. Like these are, of course, like as I mentioned earlier, these are complicated financial systems when they exist on chain, like these decentralized stable coins. There's quite a lot of risk around how the smart contracts were developed, and if a vulnerability could be found, an exploit could happen. And users should, of course, be aware of that. That there's some smart contract risk behind using these systems. And then there's also quite a bit of risk around governance for these systems. A lot of the parameter setting, for instance, of these systems and how these systems evolve over time is set by well, a DAO, like some sort of decentralized governance layer. And something that people should be thinking about more than they probably are already is how secure are these governance layers, and how likely is it that like governance is going to work together with the users of the protocol to like make the protocol like best for the users as opposed to, well, best for the governors. And then there's also an element of just like pure economic design risk, of course, which you saw like materialize in Terra. It's materialized at times in DAI and a lot of other stable coins where the mechanism wasn't necessarily like kind of fully thought through or fully formed, or there were like kind of failure modes to it that needed to be addressed. And well, sometimes those failure modes, of course, actually lead to failure. Sometimes they lead to just like a hiccup and the protocol can recover, but they're all tangible risks.
Yeah, can you rank the stablecoins today? Is there a way to rank them? Is there like a single best stablecoin?
People have tried to do that, and there are some rating agencies now. I would personally take issue with trying to rank them in like a very clean way, just because it really depends on which risks you as the user are worried about, and different users should be worried about different types of risks probably. And so for some users, like a lot of people try to dunk on Tether quite a lot because it's well, I mean, the truth is it's just like a sketchier organization than like Circle. That's hard to refute. But a lot of people use Tether, and I think for very rational reasons, that it has very different risks than using USDC, especially if you're based outside of the US. And so It's hard to say that Tether is worse than USDC necessarily for those users. Actually, they seem to be finding it better because of the risks that they're probably worried about.
That's true. So there's not
so what I would find
single
best
stablecoins up to the users.
I would find best to have like maybe a ranking, but based on like take different categories of users, I guess. Describe what risks they're worried about, what they're looking for, and then for each category, I think it's a lot easier to kind of like rank stablecoins based on like that particular user group, basically, and what they're worried about. Yeah. This is also kind of where Gyroscope fits in, I would say, because like one of our missions with Gyroscope is basically saying, well, all of the stablecoins in the whole space have their own risks, and we think you can make something stronger by building basically on top of all of those risks, by stratifying all of those risks, and providing like a one-step solution for users that if they want to have like kind of what we think is like the best risk-adjusted exposure and also like risk-adjusted yield source, that's what Gyroscope aims to be, and that we think it's very feasible because like while all these different stablecoins have very different risks, and you can potentially better manage the exposure of the different risks, and that's how we've designed Gyroscope.
That's awesome. I think it's probably time to dive into how Gyroscope works. I think I've talked to a lot of people, and it seems that Gyroscope is the one thing that a lot of DeFi OGs have talked about, but nobody really understands how it works. Just as you said, stablecoins should be complex. And I'm really on a mission here to try my best to understand how it works. So I guess just from a top overview, like, please explain like how does Gyroscope works and how is it different from some of the familiar stablecoins that we know of, for example, DAI or other ones.
Yeah, definitely. I'll start this by framing it as like, so something I said before was that like all of these stablecoins are just inherently complicated systems. There's a lot going on, and if you want to ignore a lot of aspects of like how stablecoins work, you can make it look a lot simpler than it is necessarily. But that's not the approach we took. We wanted to basically confront all of the risks and all of the just inherent complexity head on, and be able to have mechanisms that like specifically manage for all these different sorts of risks and all these different sorts of complexities that just realistically come up, handle them as opposed to sweeping them under the rug basically and pretending they don't exist. But that also makes it like just inherently more complicated to describe everything about Gyroscope, which is one of the hurdles that of course we've encountered. So I think it's very important, of course, to then just describe in a very simple way how does Gyroscope work. But then there's so many layers that you could like peel back about like actually how does it work on all these different levels, because you need all these different levels to actually manage like the risks that actually come up. So yeah, starting at the very top, like what is Gyroscope in a very simple way? It's basically like a risk management layer for stablecoins. It's packaged as a stablecoin itself, but it's backed by the space of stablecoins and soon potentially more assets than just stablecoins. But the idea is you have this space of assets. They all across the space, they have different risks, and Gyroscope tries to build the thing that you can build on top of the space of risks that manages the risks best, so that you have something that is a stablecoin and something that's easy to use because it's just packaged as a stablecoin, but it manages these risks kind of like under the hood for you. And I can then step through like how it actually does that. But of course, that's where it like starts to get a lot more complicated because like, well, there's many mechanisms because there's many different risk factors. How I would start to describe that first is just that like we built Gyroscope in what I'd call like a modular way. There's a lot of existing infrastructure that's good and should be built on top of. So here I'm thinking of basically you have the other assets in the space, you have the oracles that exist in the space, you have like automated market makers, you have all these different sort of mechanisms, and Gyroscope builds like kind of a modular stack for how its stablecoin is constructed. And what it does is basically sets up something where if it can, it uses the existing infrastructure. So oracles might be a good example here. We use Chainlink oracles as like basically the main source of like pricing information for the assets backing Gyroscope. But where we can add kind of extra guarantees on top, like extra safety mechanisms, we then do. So if everything's worked, so for the example of oracles here, like we use Chainlink oracles, they're usually very dependable, but they come with some oracle risks, and we want to address those. And so the optimistic sort of outcome is we use the Chainlink feeds, but there's an extra mechanism that basically detects and kind of like aggregates information from a few different sources on chain and tries to detect, is the Chainlink price, does the protocol think the Chainlink price is correct? And if the answer is yes, then it just proceeds and business as usual. But the important thing is that if the information is kind of conflicting and it's not clear that the Chainlink price is correct, then the protocol doesn't necessarily trust the Chainlink price. and it kind of disallows dangerous actions. And so, if in effect this means that you have some extra safety guarantees on top of the best infrastructure that exists already, and if that infrastructure has an issue, these safety mechanisms can potentially catch that, and in most cases, I think would catch that. And then Gyroscope is stronger because of it, because it can catch those sort of issues.
Yeah, before we go too far, I want to jump back to why you guys need a Oracle in the first place. So perhaps we can maybe touch base on what makes Gyroscope an all-weather stablecoin. Obviously, you guys are backed with different vols, as far as I understand it. There's USDC, there's USDT, and there's a bunch of others. So just before we talk about the oracles, how do you kind of use the oracles in the first place and make sure that it is indeed all-weather?
Yeah, that's a great question, and I think that so basically any stablecoin, any decentralized stablecoin, anything that exists on chain, like its mechanism exists on chain, needs to know it needs to have an oracle to know what its assets are worth in terms of its target. Supposing its target is USD, which doesn't exist on chain. If USD existed on chain, then it might be a different story. There may be some ways you can get some direct information from on-chain sources, like a DEX, for instance. You might be able to get some pricing information from a DEX, although that has other issues potentially that you then want to think about. But we can go into that later if you want. But basically, because you're targeting something that exists off-chain, you have to have some information bringing in about what is that off-chain information? And for a stablecoin, why you need that in the actual user flow, I guess, is if you're minting or redeeming these stablecoins, the system needs to know what your collateral that you're bringing into the system is worth, so that the system is actually secure and it can actually target its target of USD.
Got it. Makes sense. And how does user redeem or mint Gyroscope stablecoin?
So for Gyroscope, the main Gyroscope mechanism is a reserve-backed model. And what this essentially means is that there's a reserve of assets that the protocol owns. Another phrase for this is protocol controlled. I'm blanking on the term. It used to be a popular term.
Control liquidity?
That's a tangential term. I guess that works too. But there's protocol controlled assets, or it used to be a bigger term with FAI, for instance. But I think of it, I think the cleanest phrase, honestly, is just a reserve of assets. The protocol owns these assets. It's the balance sheet of the protocol, basically. And the protocol should have rules about what it wants to take onto its balance sheet in different circumstances, and what it wants to take off of its balance sheet in different circumstances. And this is where the mint and redeem mechanism comes in. It's designed to be the means by which this balance sheet can be expanded or this balance sheet can be contracted. If you're minting, you would come to the system. The system would tell you what assets it wants to take on. And this is where all of the safety mechanisms would kind of aggregate to basically tell the system what exposures is it willing to take on without becoming too risky, basically. And then you as a user can provide those assets to mint a new stablecoin, and that expands the reserve that then backs the stablecoin. And if you're redeeming a stablecoin, similarly, it'll tell the system which assets is it willing to let go of, because it still wants to maintain a healthy exposure across the risk space. It doesn't want to lose all of the exposure on one area and gain exposure on another area, for instance. And so the redemption mechanism is just the reverse process. And you can redeem your stablecoins considering for any of the assets in the reserve, as long as it doesn't push the protocol's exposures in a bad way.
Yeah, one thing I'm trying to understand is like, who's the counterparty to take all the I guess like unfavored asset, or the asset that the protocol doesn't want. For example, let's say like Tether goes unpegged and GYD remains like pegged. However, there is USDT in the reserve, right? So
Right.
in that case, who's taking the risk of like Tether unpegged, whilst making sure that like the GYD doesn't.
Right. Yeah. So this comes down into the mechanics of like, how does the arbitrage work between like primary market, like where you're minting and redeeming stable coins, and secondary market of where kind of normal swapping of GYD works. So the first level is like, who's taking the exposure of like a depegged asset. To some degree, the protocol is, of course, taking exposure. It has this asset on its balance sheet. But before the exposure has turned bad, there's the basic safety rules of the protocol that stop the protocol from taking too much exposure of a given asset. So that's kind of the first layer there, basically. Like, before anything bad happens, this just like stops anything too bad from happening later. But then, what happens?
With the Oracle. Okay.
Right. Yeah. Well, there's Oracle risks. Like, the Oracle could tell you a wrong price, and then you want to be able to control for that, because if the Oracle tells the protocol a wrong price, that can be really damaging to the protocol. It can let collateral go at a bad price. It can take collateral on at a bad price, and that's why we think you need these extra like Oracle safety mechanisms, because it shouldn't be so easy for like a bad price to get into the protocol and cause an issue. Today, the default treatment of oracles is just assume they're always correct, and then like allow infinite actions at that like supposed assumed correct price. Whereas the gyroscope model is, don't assume it's correct, try to evaluate if it's correct, and if for all the information you have it seems correct, then allow some actions at that level. But not infinite amount of actions either. You can do infinite amount of actions, but it has to be like spread out over time. And the other side is, if you aren't sure, if the protocol isn't sure that the price is correct, then limit actions even further until you're sure again that the price is correct. And then, so then I mentioned that like if you have a depegged asset in the reserve, then the rest of the story comes down to like, how does this arbitrage mechanism work? So I can also dive into that now if you want.
Yeah, that'd be great.
So how does like reducing exposure or taking on more exposure when there's like a depegged asset actually work? And this plays into like what happens with like this arbitrage market. And let's say there's a depegged asset. Let's say it's USDT, and that there's on secondary markets that GYD is trading off of peg, because the arbitrage mechanism won't kick in unless like secondary markets are trading off of peg. If it's trading off of peg, then there's potentially an arbitrage opportunity with the primary market, but it depends on what the primary market is, what the system is judging the current situation to look like. Basically, another facet of the system is not just like controlling for exposures of different assets, and this is like the diversification layer, but it's also making sure you always have a sustainable system in terms of like being able to unwind the systems through redemptions. You don't want to. You can think of this as like a bank run protection model, I suppose. So if you have a system where you could like always redeem for $1 worth of assets, even if you don't have enough assets to back the system fully 1-to-1 because you had like a shock to one of your assets, then rationally, like what would happen in most situations is basically what happens to Terra. Like, you get as much redemptions out as you can near 1-to-1, and then everybody else is left with nothing. And so you don't have like kind of a way to unwind the system cleanly. And that's what this like bank run protection wants to avoid. Like first of all, the diversification layer tries to make sure that like you don't get into this situation in the first place. But if you do get into this situation where you're under reserved because there's like a shock to one of the assets, then this bank run kind of protection mechanism kicks in. And this bank run protection mechanism basically figures out for the system what level of redemptions is sustainable in terms of like being able to support the price, but also like making sure you always have a clean way to unwind the system and you don't go to zero. There's always like some redemption value for stablecoin holders.
Okay.
And how it works for that is it allows some amount of like normal redemption flow around 1-to-1, but after this normal sort of amount is exhausted, then it finds...
Sorry, around 1-to-1 means you don't get any tether in it when you redeem.
Oh, so right. So you can redeem for various assets. And let's say you redeem for like a basket of assets. Then you are getting, in some cases, like near 1-to-1 with some protections for like what happens if you try to redeem for tether, I suppose. You don't want to be in this. So let me clarify this a little bit. If you're redeeming for USDC in this situation, and you still know, and the system still knows what USDC is worth, in some limited situations, it can still support like some near 1-to-1 redemptions of USDC. But it doesn't want to do too much of that because it wants to kind of maintain like a healthy exposure, and also doesn't want to sacrifice like reserve value too much. But if you're redeeming for Tether, but Tether is like 95 cents, it also doesn't want to let you redeem for $1.05 of Tether, because if this is just a transitory downturn, which like you don't actually know, like look at what happened to USDC back in back last year. Like it went down to like 85 cents, but ultimately it recovered because like, well, the backing of Circle recovered. And so the system doesn't want to allow something like that where it's like potentially paying out more than it should be worth. In this case, like it's actually like quite a bit unsure about what Tether should be worth. And so you can redeem 1-to-1 for a Tether in this situation, but that doesn't necessarily mean like $1 to $1.
Got it. Yeah, please go ahead with the...
Yeah. So between like all of these things, like you can redeem for like basically all of the reserve assets, still according to like maintaining the diversification rules of the system, and depending on like on how much redemptions are kind of like demanded here, as well as like which action, how much of the reserve has had a shock, and like what the reserve value is. You can still have an idea of like arbitrage against the secondary markets that keep the price of GYD in this window that's like between slightly above 1 and down to like the reserve value of that's backing the system. But this is kind of the best that the system can do in this situation, because it is, in this situation, there's been a shock and it's under reserved. It's not sustainable to support completely at peg. The best you can do is kind of support in this hopefully limited range that still like allows the stablecoin to be quite tighter than a lot of other stablecoins in the space.
Yeah, in that case, I'm trying to understand how much profit there is for the arbitrage, like what created the profit. So you redeem it. So you use 1 GYD, and then GYD is trading at, let's say, like 0.95, and then you redeem USDC, and then there's $1, and then you make 5 cents. But what's the mechanism for the demand of GYD?
Yeah, you got the arbitrage mechanism there, right? That's how it works. For demand of GYD, it comes down to the use cases of GYD, I suppose. Which
that
still...
helps it remain pegged in that scenario.
Oh,
so
right.
I feel like their demand for like redeeming GYD, but what is the force that helps GYD get back to peg?
Yeah. So in terms of demand for GYD, sure, there could be some redemptions, and could be quite a lot of redemptions in this situation. But you also have to compare it relatively to the rest of the space, because GYD is also like a minting facility for stablecoins too. And if GYD is comparatively seen as more safe than like other assets that may be faring even worse, comparatively GYD might actually be in more demand than other stablecoins. And that's what we aim to, like, that was one of the aims of the Gyroscope design, is basically be this all-weather sort of design. If you're using GYD, you can kind of rest easy that all of these different risk factors are being managed basically by the design of the system. And so the effect of any one shock on the system should be less than if you were like unlucky enough to hold the stablecoin that had like full exposure to that shock, for instance. So the good example might be like, what would have happened to GYD in like the USDC crisis last year, and like how would it fare compared to like holding USDC directly? And it was designed in a way where sure, you can't really say exactly what will happen to GYD price, and it may in fact like depeg a bit, but it should depeg less than if you were just holding USDC, how much USDC depegged, because it's managing the exposure of the different risks, including the risks of holding USDC.
I think the right way to kind of like, from my understanding, to say is, so in the world of stablecoin, there are a lot of end of the black box, right? You don't know how they operate. There are obviously a lot of risks that you can't foresee, for example, the regulatory risks. And there's essentially no way for you to find the best stablecoin. And Gyroscope come in to say, if you don't know for sure like which stablecoin you should hold, you should probably like mint as GYD, because like it is better off than holding just that one stablecoin. And end of the day, like you get racked by the US government, for example, which you cannot foresee.
Yeah, I think that's a great way of putting it. If you want to go through all the details of like everything in the stablecoin risk space, you can probably find like the exact stablecoin you want to hold, or basket of stablecoins, to like get the exposure you want, if that's how you think of it. But for most people, like how GYD is constructed, it just does that for them, and basically they can rest easy, just use one stablecoin that does it for them.
Got it. So speaking of the vaults within GYD, you mentioned there are various different stablecoins. I even mentioned that in the future there might be non-stable coins in the vault. Can you explain that a bit further? And it would be interesting to hear what are your favorite stablecoins, and if you're bullish on them, if any of the newer stablecoins interesting.
Yeah, so the stablecoins that we have calibrated for the reserve right now is a fairly conservative choice. It's how we launched the system without like taking on too much risks, especially because the stablecoin space is still fairly young. Like there's a few large contenders that kind of like meet all the requirements about like liquidity on chain, like track record, and kind of like being able to maintain peg, actually, because they have the liquidity on chain to be able to meet changing demands. But there's a whole host of like new stable coins that like we hope to reach that level someday, and then like also build into the reserve, because basically the more offerings you can build into the reserve, the stronger the reserve should be from this diversification standpoint. But the stablecoin space isn't kind of like there yet. Most of these new stablecoins don't necessarily have enough liquidity or enough track record. But hopeful that changes. What we started with now is kind of a mix of the major stablecoins. So this spans USDC, USDT, DAI, and also like Liquidity and Curve USD. And what we've tried to do in kind of shaping this kind of initial reserves strategy is account for as best as we can from this like fairly limited like basket of other stablecoins so far. What are the different risk exposures you're taking on with these different assets, and how can we best segregate the risks so that ideally you're taking on like bits of this risk, bits of that risk, bits of this risk, and that they don't like all combine into like one category. And
Got it.
on one side, we have like the kind of like much more decentralized kind of like stable coins. So LUSD and
Stablecoins in the vault of GYD. I'm very interested to learn like how did you choose this kind of stablecoins? And as more of these stablecoins come out of the picture, we saw like new funding news like every week of like new stablecoins like Mountain Protocol, a few other newer ones. It would be great to hear how did you choose the current ones, and if there are any exciting new stablecoins that I'm looking forward to adding on in the future.
Yeah. So we set up the GYD reserve. We calibrated it at launch to be fairly conservative, and basically make use of the stable coins in the space that exists today, but they have to pass like a threshold of like, for instance, how much liquidity they have, how much ability to maintain peg they have, and like an amount of track record that you can actually like look back on and kind of like help to evaluate risk. But that said, like the stablecoin space is fairly new in a lot of regards. Like there are some established players, but not that many that have like kind of gained a lot of traction yet. But there are also quite a lot of new players that have entered the space very recently, but don't necessarily have kind of like the liquidity requirements or kind of like on-chain usage requirements yet that make it very comfortable to like include it in a conservative reserve. So it is something we expect to change probably pretty dramatically in the near future as a lot of new stablecoins gain a lot more traction, gain a lot more liquidity, and can kind of like pass those thresholds that they can be used in the reserve in a safe way. But I think of it as like the more stable coins you can include in the reserve, the potentially like much safer you can actually make the reserve, the more diversification potential you can actually build into the reserve. And so I really think of like the reserve we launched today as like a starting reserve, and it should be looked forward to like expand this as more stable coins can be safely included in it. For the reserve that we launched today, what we've done is take like the major players in the stablecoin space, and to the best extent with those players that we can, try to set up like a segregated risk structure so that ideally the GYD reserve is taking on like some amount of this risk, some amount of this risk, and some amount of this risk, etc. But that the risks aren't kind of like bleeding together into like one big risk factor or one big kind of like asset exposure if something went wrong. And the stablecoins we've started with are USDC, USDT, DAI, and also Liquidity, LUSD, and Curve USD. And how we think then of like how the risks can be segregated, USDC and USDT like definitely cover like the centralized risk factors. And as we were talking about a bit earlier in the podcast, the risks of USDT are fairly different in a lot of ways from the risks of USDC. And so that's why we want to include kind of like both risk kind of like viewpoints in the reserve. And then we think there's value to having presence of both in the reserve, and helps you to some degree like at least mitigate the risks that are within this centralized asset class. And on the other kind of end of the spectrum, LUSD and Curve USD are probably the most decentralized stablecoins that like can actually pass the bar of like liquidity requirements to make it into the reserve right now. And they kind of cover like the decentralized risk factors. And in the middle, I think I also made a comment earlier in the podcast that like some stablecoins have kind of like blended categories in a lot of way and kind of take on risks from different categories in one. And DAI, in my view, kind of like straddles the category of risk factors right now, to some degree. a lot of its backing comes from kind of this decentralized mechanism, the original DAI CDP mechanism, this like leverage mechanism for minting DAI. But a dominant source of backing has become basically like real world asset exposure, which puts like DAI also in this like centralized stablecoin sort of exposure category. And so I see it as like kind of stratifying both classes, and you want it to, it's kind of like its own class now, but you have to account for how it like takes in risk from both categories, but also like helps you get like differing risks. Like it helps you get some RWA risk exposure, but at the same time helps you get some decentralized stablecoin risk exposure, but in its own sort of like blended system, which is why we also kind of want to segregate it from the other asset risks. So that's how we started. But yeah, looking forward to expand that because I think a lot of new stablecoins like would add value in terms of like more diversification. They just need to be ready in a state where like they can be safely added.
Yeah, there's one thing I was also thinking is from a user perspective, the risk of holding stablecoin is one thing, and another thing is like how useful the stablecoin is. So for example, if I want a higher yield, chances are I have to go after a newer stablecoin that don't have a track record. And if I want to buy a lot of Bitcoin, I might need to have Tether. What do you guys think about, I guess, like probably the market fit of GYD in terms of like how it generates yield and like how is there a way to kind of like balance the risk and the kind of the yield or the attractiveness of GYD at the same time?
Yeah, there's a lot of potential use cases, and we're kind of in the stage now where we can kind of start hammering down on these and like kind of actually like start to develop these use cases. Like GYD is kind of at the point where it has a track record. You can point to a track record of liquidity and stability that's like a pretty good track record now. It also has some first adopters, but we're at a point where we can start to leverage that basically and develop more use cases, bring in more users, and in particular bring in users that like needed to see the track record, I guess. Like these are kind of risk conscious users, which GYD is designed to be this like risk conscious stablecoin. So to some degree, like its desired users are the best match users are those who are conscious of the risks, but then they need to see this like track record. So you kind of have to like have the system exist for a while, work for a while before you can actually bring those risk conscious users on board, compared to basically bringing on like degen users, which aren't as risk conscious, are willing to jump in right away. But like, I mean, GYD has some things where it could be used for degen sort of purposes, but it's not designed as like a degen stablecoin necessarily. And so it's like first adopters aren't necessarily like degen adopters.
Makes sense.
And then there's a number of like different use cases you can develop for people who just want to like have stablecoins as like a either a savings instrument or as just like an asset to hold while you're in between like taking on other exposures. GYD isn't bad at that right now. Like the state of trading on chain is such that if a stablecoin is fairly liquid and maintains peg fairly well, which GYD does, it's very liquid to move in and out. It's maintained peg within a few basis points for its entire existence so far, and if you're choosing where you want to store your assets in between things, GYD can be a very good choice for you already. So that's one kind of idea. It's also very good as a liquidity provider asset. So one of the main ways GYD is used today right now is like basically in a grander liquidity strategy as like an LP in AMMs. If you want to be a stablecoin LP and be earning kind of the LP yields on top of your stablecoins, if you're at all interested in like risk diversification, using GYD can be a great tool to lower your risk exposure of being a stablecoin LP. If you LP in like a a variety of these GYD pools that pair GYD versus another asset, you get some degree of risk diversification. If there's a DPEG of one of these assets that you're LPing, your exposure is limited to kind of like part of your LP portfolio, and the rest of your LP portfolio can continue working potentially. Because like GYD is this like kind of central asset in your strategy, and it's designed to be as a resilient central point as you can have. And if you have one pool that goes down because an asset depegs, that doesn't mean that GYD necessarily goes down, and the other pools at least get like a segregated exposure to the asset that went down. And that would be in comparison to, for instance, being an LP in like the Curve 3 pool. If you're an LP in that pool and one asset goes down, so think what happened back in the USDC crisis last year, then basically your entire exposure through your LP position has become that depegged asset. You didn't get any risk control. And on top of it, you're not earning any fees anymore because, well, no one can trade through this pool anymore, basically.
Yeah, I remember that. So essentially, you can understand it as like for being a stablecoin LP for GYD, you're only facing the risk of the stablecoin you're pairing with, right? And you don't have to worry about like a lot more for earning that yield.
Right. You can potentially get similar yields in terms of like swap fees, and these are improving actually for GYD pools as like more integrations happen of these GYD pools. You can potentially get similar swap fees, but on top of it, you get just like a better risk profile in terms of the risks you're actually taking on as an LP, because like GYD manages those risks for you. Even as an LP, it still manages those risks for you to some extent. And another exciting thing about like some of the newer GYD pools is that these pools are designed to also build in Aave yields on the other side of the pool. So not only can you get the swap yields from facilitating stablecoin swaps, you also get the Aave yields from like the USDC side, for instance, which is actually quite a bump in terms of like stablecoin LP yields these days. And you also can get in the future potentially. There's a mechanism built into GYD to forward some of the protocol's revenues, which it earns revenues even today, because like the reserve earns yield of its own, and there's a mechanism to be able to forward that to support certain LP pools as well.
Totally. Yeah, thanks for these insights. It's definitely fascinating.
One other thing that I would just highlight quickly is we also recently launched the yield-bearing sGYD. And this is a kind of a product that is in many ways parallel to like SDI, but it's based on the GYD system, of course. So the GYD system earns revenue based on like what's happening in the reserve and what sort of yields the reserve assets are earning, as well as kind of like swap fees that accrue to the protocol. And there are some swap fees that accrue to the protocol today through what we call like AMO pools that are also part of the reserve. So pools that are basically composed of reserve assets. And there's also like a means to kind of like turn on a fee switch later that generates like also protocol revenue from its other product lines, from these more efficient liquidity pools that are also performing pretty well as a product class, I would say. And from this like revenue that then accrues to the reserve, by default, that just increases reserve value, increases safety of the system. But the sGYD mechanism that we released a couple weeks ago now provides a means to forward some of that yield onto stakers of GYD. So you can deposit GYD into sGYD and be able to earn some of this yield. And we think of this as basically the best risk-adjusted yield that we think you can get in DeFi, because GYD gives you this like nice kind of balanced exposure to different risks. The yield is also a nice balanced exposure to the different yield sources, and can be quite good at times, we think.
So what's behind the yield is the LP. Is the LP, right?
What's behind the yield is what the Gyroscope reserve assets are actually earning. So you have a basket of reserves. They're deployed in various ways, and you can see, for instance, on like the GYD page where assets are deployed today, and where they're deployed is earning a yield back to the protocol, as well as like potentially in the future other yield sources from other product lines coming back to be just like by default extra reserve assets. But then because there's extra reserve assets, there's also the ability to forward some of that yield to users.
Where are they deployed now?
And so right now the main reserves are in sDAI, so like earning the DAI savings rate, as well as earning AVE exposure on USDC. These are coming from these sort of like AMO reserves that I was describing that are kind of part of bootstrapping the system and bootstrapping liquidity for GYD. But as scale of GYD is reached, there's kind of like a more diversified reserve that I was laying out before that as scale is reached, the other reserves will be filled out basically. And then you'll reach a point where there's like a kind of a very wide exposure across like all the different risk factors. And this reserve is expected to also like change over time. So that's like kind of an overview of like what does the reserve look like now? How is it expected to change as it scales? And also how is it expected to change in the future?
Yeah, you mentioned earlier that Gyroscope can also be minted from non-stable assets. I also want to touch base on that before we wrap up. That sounds very interesting too.
Yeah. So what we envision is that GYD will look in many ways like DAI or USDS with the rebrand looks today. So for DAI, there's like two main issuance mechanisms. One is coming from the original CDP mechanism, which is usually from people like achieving leverage, where you mint DAI or borrow it kind of into existence, backed by your collateral, over collateralized position. And the other mechanism comes from the PSM, the peg stability module, which is basically like a one-to-one mechanism for minting DAI against USDC. And a lot of this USDC reserves have been transitioned into like real world assets and such. So the PSM I think of as incorporating both the USDC reserves as well as the RWA reserves. And for Gyroscope, what we've unrolled so far is basically what we think of as a better PSM, peg stability mechanism version. It's kind of designed to automatically control for the exposures that the protocol takes on in doing this mechanism. And so we think it's a much more robust mechanism than just like the PSM looks like today. But at the same time, like we also envision that like, and there's a slot open in GYD to plug in leverage mechanisms where you could mint GYD against over collateralized positions. And likely this will be rolling out kind of soon, but like the aim is to use existing infrastructure that already does that well, as opposed to necessarily building our own new version of how to do leveraged loans. But I do also want to mention that there's like a third mechanism for a third slot for generating GYD liquidity. And this is going to take the form of we're working on like a V2 mechanism of Gyroscope actually that will, what we think this will do is it'll kind of push the boundary on the efficiency of what you can do with liquidity between decentralized assets, and in particular, like between decentralized stablecoins. And so it'll plug in, kind of build off of GYD and on top of our Gyroscope liquidity pools, which we call ECLPs, and will provide what we think is like basically the cheapest way to like generate stablecoin liquidity, but using kind of like a feature that's hasn't been used before in the space, but kind of like borrow some intuition from how central banks like kind of are able to generate liquidity between currencies, but in like a new mechanism. So yeah, I don't want to dive too deep into that right now. So you can kind of like look for more information coming on that soon. But there's a kind of like a third slot left in the GYD protocol to be able to plug in this coming mechanism.
Yeah, well, we have had enough of the stablecoin knowledge right now. Awesome. Yeah, sorry due for another podcast. Love to have another one to dive into B2 when it comes out. Yeah.
Yeah, definitely.
So, yeah, thanks for coming, Ariah. And just before we wrap up, is there any final thoughts or advice that you want to give to our listeners?
Yeah, we kind of framed some of the early discussion about thinking about like what are the different stablecoins, what are the different stablecoin risks, and like what do users want to do, I guess, and like how should they think of this? And there's certainly a lot of advantages to using centralized stablecoins. I think that's pretty clear at this point, especially when it comes to like kind of dependability, track record, and liquidity on chain. And also when it comes to a lot of risks, like there's not a great track record of like new entrants to the stablecoin space, like actually like thinking about risks well and providing like a risk adjusted solution that's also decentralized. And so I want to kind of reinforce, I guess, that like Gyroscope, it was aimed to kind of like fill these shoes, provide something that is decentralized, but also like is able to kind of like actually go leg in leg with centralized stablecoins when it comes to like actual dependability and stability and liquidity. And this is something we're actually seeing with GYD today. It's maintained the peg stability of basically only centralized stablecoins, as well as the liquidity that like that can actually compete with centralized stablecoins. So this is basically like the one thing I like to show is that the swap velocity of GYD, which kind of accounts for the size of GYD, is on par with Tether, basically, which is most other stablecoins are just much below Tether in terms of their actual like usage compared to their size of how much swaps they can actually accommodate. And so yeah, I want to reinforce that GYD was designed to be this sort of thing. You could have a decentralized system that like also achieves these sort of properties. It can be like a very risk conscious stablecoin. And so we really want to go to market with that sort of a user group in mind. But the last thing I want to add is that I think there's competitive advantages of using decentralized stablecoins, of having decentralized stablecoins that can provide extra advantages, extra ways to compete with centralized stablecoins that haven't been realized yet. And the V2 mechanism will be one such way. It's a way that you can do a lot more by nature of being a decentralized asset that a centralized asset just can't do. And a lot of other DeFi applications are also like kind of this nature, where you can do a lot of very cool things with decentralized assets in particular. And I think we'll be seeing kind of like a lot of movements in the stablecoin space where there'll be new innovations around what you can do with decentralized stablecoins and decentralized assets. That'll be new ways to compete with centralized assets. And I don't think it's a foregone conclusion that like centralized assets are just like the best way for users to use stablecoins. I think we'll be finding that there's a lot of advantages that users will also be realizing to using decentralized assets. So I think it's a quite exciting time to be in the space, and I think there's quite a lot that will be coming up.
Yeah, this has been an incredibly informative discussion, and hopefully I did a good job, asked the right questions so that the listeners now can have a better picture of Gyroscope. Again, thanks for joining us. So for the listeners who want to learn more about Gyroscope, where can they find you?
So the best place would be following our Twitter, and we're Gyrostable is the Gyroscope account. You can also join our Discord. There's a link on our website, and our website is gyro.finance. And you can also just explore the stats about the protocol, explore the app, and definitely encourage you to try out sGYD as well as our liquidity pools. It's available on a number of networks. Yeah, take a look, and Twitter is probably the best place.
Awesome. Thanks again for joining.
Yeah, thanks for having me.
Right, have a good one.